Thank you very much for that kind of journey through the history, the present, and looking forward to where the bank might be changing, and in particular, more openness, transparency, and clarity. So I know we have students here from across different disciplines. We have students from economics, from the business school, and from other departments as well. So I'm going to throw it open. We might take, depending on the nature of the questions, 1 or 2 questions at a time, and then put them to you, if that's all right. So if you put your hands up and say who you are and where you're from, and then we have a microphone, I think, in the room as well. Who would like to begin?
Thank you very much for the very interesting talk. Which priorities would you consider to be the most critical for the Bank of England over a 3-year horizon?
Okay, let's take another question here. Mark, can you shout or do you need the mic?
So I'm Mark Taylor, I'm Dean at the Business School. So the last time, or a previous time, a Monetary Policy Committee member gave a speech here was Steve Nicholl, NPC member, around about 2006. And I noticed something striking from your chart is how much the world has changed in the last 7 or 8 years. Even the long span pictures actually that big growth in debt and so on. But it's interesting that something I picked out, I just happen to have a copy of Steve's speech here, I'm afraid. One of the points he says is this: it is neither necessary nor desirable for monetary policy to respond to changes in asset prices, except to the extent that they help forecast inflationary or deflationary pressures. He also gives 3 reasons why this is the case. The first is a target instruments issue that you can't chase 2 targets of one instrument that dealing with asset price inflation may be pro goods and price service inflation rate. The other is that you should only be concerned with asset price inflation if it's actually a bubble, detachment from fundamentals, and bubbles are very, very hard to predict in time. And thirdly, that the long and variable lags of monetary policy mean that it'd be very difficult to deal with asset price inflation using monetary policy. Right? So my impression is that the bank would you agree with what Steve said back in 2006? And if not, why not?
Okay, for fear of not being able to summarise Mark's question, do you want to take Mark's question first, Minouche, and then we'll go back to the priority question up there?
Very good. So let me, I think the view that the older view was too difficult to anticipate bubbles, don't even try and pop them, let them happen and then try and clean up afterwards. That was the sort of old Greenspan view of how to deal with that. I think what's changed is that we have new tools. So I don't think we would say use monetary policy to try and dissipate asset price bubbles. But we have other tools, macro-prudential tools, micro-prudential tools, which we didn't have. Macro-prudential, certainly I think I should explain what macro-prudential tools are actually. Macro-prudential tools are ways to deal with systemic risks in the financial sector. So as an example, in the UK, actually before I joined the bank, there were some concerns that the housing market was getting a bit frothy and that house prices were rising in a way that was out of line with what the fundamentals should be. And at that time, this was a year ago in the summer, the Financial Policy Committee said, actually, we're going to set a limit on the loan-to-income ratios that banks should be lending. That banks shouldn't lend more than a certain percentage of their books at very high loan-to-income ratios, where people were borrowing very high, taking on very high mortgages relative to their income. And not only that, but some other factors as well helped calm things down in the housing market. And I think the existence of macro-prudential tools helps us square this circle of what do you do when you're concerned about asset prices. And I think we're starting to see, it's a new tool, but we are starting to see many countries use it with increasing effectiveness. So, and then in terms of priorities, well, I think the top priority is to get inflation back to target. As some of you may know, inflation's a bit low at the moment. In January, the latest annualized number we have is 0.3, it should be 2%. So that is clearly a key part of our mandate. And I think the other priority would be to complete the sort of reforms to the financial system that would ensure the kind of stability that we want to see going forward. You know, banks are, there's a whole slew of regulations which have been instituted in terms of banks having to hold capital, restrictions on leverage, higher levels of liquidity requirements, and so on, and also resolution regimes and having loss absorbing capacity, all of which are intended so that if there's another problem in the banking system, that the bill doesn't end up with taxpayers and that we don't have systemic instability as a result. So I think that agenda of implementing and completing that regulatory reform agenda and implementing it is really the other major priority that we have ahead of us.
Okay, we've got a question here on the front row, and then if somebody could get a mic, there's a gentleman at the back there.
My name is Marcus Miller. I worked at the Bank of England once for 1 year as an economist, and I'd like to ask you about constructive ambiguity. You've been very critical of it, but sometimes it's a good strategy. If you're trying to score a penalty, you don't signal to the goalkeeper which way you're going to kick. So my question is, are you so sure about these new instruments of supervision and resolution that you can really dispense with it? For example, why not hint to the banks that if they help in tax evasion, they might lose their license?
So one question on constructive ambiguity, which we use quite a lot in the civil service. One up there.
Thank you very much. Just a quick question. Do you think you could elaborate a little bit further on the low headline inflation rate and what might happen if it turns negative? How the bank is likely to respond?
Okay. I think in general, the tax evasion thing, I think that's a different problem. But I think there one doesn't need to be ambiguous at all. Actually, it can be quite clear that if you break the law and if you violate, there will be consequences. I think the only place where I indicated in my talk that there is an advantage to ambiguity is where us providing liquidity insurance to an institution, should it become public, would jeopardize the stability of that institution. There are times when we need to be able to act covertly in providing liquidity insurance when we think an institution is basically solvent but has short-term liquidity problems. And I think there, it's not an issue of ambiguity, but I think it's an issue of you don't disclose until it's no longer a financial stability concern. But other than those kind of situations, I think it's hard to argue in the kind of financial system that we have now, with its level of complexity, with its degree of globalization and interconnectedness, that being ambiguous is helpful. It's hard for me to think of cases where having clarity about your policies, other than this one that I've just described, would be better. And then on the question about low inflation and if it goes negative, well, actually, the Monetary Policy Committee has said that we expect inflation to be close to zero for several months, actually, in the sort of coming months. And there is, we produce fan charts that show kind of the probability of where inflation may be, and the fan charts show that there is a probability that it could go negative at some point in the months ahead. But we're pretty confident that the reason it's so low is because of these exogenous import price factors, essentially the 50% fall in the price of oil and the appreciation of sterling in the recent past, which is still working its way through the economy. So if you look at what domestically generated inflation is in the UK, it's actually roughly 1.5%. So the underlying inflation is still not that far from the target. So our expectation is that over time, that those import price effects will work their way through the system, roughly by sort of the end of the year and beginning of next year. And we will start to see, we're already starting to see improvements in wage growth, and that will help drive domestically generated inflation up. And our latest forecast is that inflation will be back at target within 2 years.
Okay, we have a question here, and then come to another one.
Hi, I'm Daniel, first year economics student, and I have a question about liquidity reserve ratios. So during the Thatcher era, I believe liquidity reserve ratios were reduced significantly, and this policy was maintained for a long period of time, till like the 2000s. And do you think this was a major factor for the financial crisis?
Okay, thanks, Daniel. And then we have another question at the back.
My name is Nancy and I'm a first year economics student. When we think of the Bank of England or a central bank, we always think of macroeconomics. So what is the role of microeconomists in a central bank, if any?
So what's the role of microeconomists and liquidity reserve ratio?
Yeah. So let's start with microeconomists. I mean, it's true that most of the economists working in the Bank of England are macroeconomists, but I think we do have microeconomists who are thinking about things like, what's happening to investment at the firm level, looking at sort of a lot of the kind of macro-prudential work has a little bit of a microeconomic aspect to it. But I think implicit in your question is that we probably don't have enough microeconomics in the Bank of England, and I think that is a fair point. I think there is probably quite a lot in kind of modern microeconomics that we could learn from, particularly some of the lessons on regulation, which could have read across to the financial sector. And then on liquidity reserves, I think liquidity seizing up was a huge problem during the crisis. And I think as a result of that, under Basel III and more recently in the context of the net stable funding ratio, we do have liquidity. We are requiring banks to hold higher levels of liquidity for themselves. And if you look at the UK banking sector, it's really striking that what has increased enormously is the amount of capital banks are holding and the amount of liquidity they're holding. And all of that is part of increasing their self-reliance in some sense, so that should they have an adverse shock, that they would be able to meet their liquidity needs, and if they incur losses, be able to absorb it with their own capital.
Okay, I've got two hands here and another one here. We have Minouche, who's the first woman to do many things. We've only had one woman asking a question. So one more hands up
Hi, my name's Sam. When the interest rate rise comes, what do you think the main sources of potential slowdown that could cause will come from? So, what will be the effect on the homeowner and the mortgage borrower and things like that?
interest rates, and then maybe down here.
Hi, I'm Katia and I'm a first year economics student. And in the light of the recent changes on the global political arena and global financial market, how would you comment on actions taken by the Russian central bank? Was it a justified decision to raise interest rate to, if I'm not mistaken, 70%?
Let me start with the interest rate one. I think the first thing I'd say is that we very much have sent a signal that our expectation is that when interest rates do rise, it will be gradual and limited. And I think that will have a significant effect in mitigating the negative consequences for different types of borrowers. We've looked very closely at what would happen to households as a result of interest rate rises and which households might be vulnerable to interest rate rises. And clearly for those households it would be a concern, but as a proportion of total households, it's a very small percentage who would be under pressure as a result of the rate rise, because we have low rates now for 6 years. But we are monitoring that very closely, and because the increases will be limited and gradual, and we expect it to only happen when wages have gone up and household incomes have improved, households should be able to absorb that limited and gradual interest rate rise. Similarly for corporates, corporate balance sheets are in much better shape now than they were before, and certainly for large corporates, borrowing conditions are very favorable and very comfortable. And again, their balance sheets are in better shape, and they will also be, I think, in a position to absorb higher rates when the time comes. But as I said, particularly because they will be limited and gradual, it should be easier. And then on the Russian Central Bank, I have to confess, I don't follow it closely enough to be able to give you a really good answer. The Russian economy has been hit by multiple big shocks, two big shocks basically, the sanctions regime and the oil price fall. And those have had dramatic impacts for Russia's growth rate and its exchange rate. And I think those are fairly unprecedented, the scale of those shocks. But I don't know enough about the policy response to be able to give you a good evaluation of whether that is the right thing to do or not.
Okay, I'm conscious of the time, so I'm going to take two last questions, but I've also got one of my own while we're looking for two last questions, which is whether you're talking to our staff or our students here, from your perspective, whether they're economists or whether they're business or what are we not focusing on enough in our teaching and learning that you think we should be looking at more, and what are the areas you think that we should focus on?
Okay.
If you're thinking about that one, and then two more. I'm going to take one gentleman and one lady, so ladies don't let me down. There's David over there.
Hi, my name's James. Do you fear that, and I'm an economics student, do you fear that increasing reserve ratios might squeeze liquidity in the economy, restricting borrowing for individuals and SMEs, and therefore restricting economic expansion?
Okay, and the last question. I'm going to have to give it to a man now. Shocking. Okay, over here. Sorry, over here.
Thanks. I'm Judge. I'm a second-year economics student. The question I'd like to ask actually builds on clarity, and that's global monetary policy coordination. So there are externalities, and we've seen this when the Federal Reserve first tapered, caused quite a big sell-off in emerging markets. So does the Bank of England take these externalities into account, and has there been any initiatives for policy coordination on the global level? Thanks.
Yeah. Okay, let me work my way backward. On the global policy coordination, it's interesting. There have been many efforts at global policy coordination, particularly through the G20. Probably the peak of global policy coordination was during the crisis in 2008, where there was a really unprecedented degree of global policy coordination. At that point, the world's major central banks collectively coordinated interest rate cuts in the crisis to try and create a sort of global stimulus. At that point, there was a collective decision at the G20 to have fiscal stimulus that was coordinated across the major world economies. And there's nothing like a crisis to kind of focus people's minds. And it was also a moment when everybody was in the same position, that there was this huge negative shock and everybody wanted to stimulate demand to prevent another global depression. So policy coordination was easy because everybody was in the same economic state and had to do the same sorts of things. Also, frankly, fiscal stimuluses are much more easy to coordinate than fiscal austerity. But it was a period of unprecedented policy coordination. I think since then, policy coordination has been more episodic, and it's harder to get policy coordination to work when times are more normal. Probably the area that's been the most active in the recent period has been on the international financial regulatory agenda and trying to get the new kind of financial stability board agenda agreed at the G20, and that's been increasing capital, it's been on liquidity, it's been on leverage, and it's been on resolution, and most recently on what's called TAP, total loss absorbing capacity, so that globally systemic banks would have to carry enough loss absorbing capacity to be able to be resolved without recourse to public funding. So I think that agenda, which is a slightly more technical agenda around financial regulation, has been the area of most focus in the recent period. But you were right to point out that, particularly at this time, there are lots of spillovers around monetary policy globally, given how active central banks have been recently in stimulating their economies, whether it's the Bank of Japan, whether it's the ECB, whether it's the Fed, or whether it's us. So it's a very big issue. And then on reserve ratios, whether at the moment, banks have very large levels of reserves with the Bank of England as part of quantitative easing policy. And that's deliberate to encourage them to lend to the real economy. Was your question whether that would be reversed or?
It was just more kind of whether the increase in reserve ratios will make it harder for borrowers.
Yeah, I think if you look at credit conditions now in the UK, for example, as I said, for larger firms, they're actually quite favorable. Borrowing costs are at historic lows. Most corporates have pretty comfortable balance sheets. They have significant cash holdings, and investment intentions are quite positive. So I don't think for the corporate sector there is a problem. There's a perennial issue with small and medium enterprises. I think in most countries, small and medium enterprises traditionally haven't complained about access to credit from the banking system. If you look at the UK at the moment, it's an interesting net lending to small and medium enterprises has declined. But actually in our surveys of small and medium enterprises, what they tell us is, actually we don't want to borrow. We've been paying off bank loans where we have cash holdings. We're able to finance investment with retained earnings. And many of them are now turning to non-traditional sources of peer-to-peer lending and other types of borrowing outside the traditional banking system. So at this point, I wouldn't say that credit conditions are constraining investment in the economy. In fact, they're actually a lot more favorable than they've been in a long time. And then finally, your last question, Siobhan, which is what should research and universities be focusing on going forward? I mean, I think the thing one always looks to universities for is the forward imaginative thinking that those of us who are in the policy trenches can't quite see because we're fighting the policy skirmish of the day. So I think kind of creative thinking about the future of the economy, what the digital economy, what that's going to do to the economic future. I think thinking about what that implies for the future of the financial system would be very important. I think the other area that I think we get asked a lot, which we don't, which is a very hard thing to answer, is with the accumulation of all these regulations that have been put in place with respect to the financial system, all for very good reasons, because we've learned the lessons of the crisis and want to avoid another crisis like we faced in 2007. What does it all add up to? And what will the banking system look like as a result of all of these changes? And will we get what we want, i.e. a banking system that's both safe and able to finance the economy and help with and manage risk effectively? And I think some thinking about adding up the impact of the regulatory reforms that we have made and thinking about whether we're going to get the financial system that we need for the economy of the future will be a very worthwhile kind of line of research for academic endeavor. And then you can always tell us whether or not we're doing a good job.
Well, that's the challenge as now, because our students can tell, well, in the economics department, they can tell better than us do whether we're giving them that opportunity to think in that way as well through our curriculum. So on that, I would like to say a huge thank you, Minouche, for giving us so much of your time and being so open in the questions as well. Thank you very much.